All right, one other quick note. The way 357 functions is 357A giveth and 357B and C taketh away, so to speak. And so under 357B, and this is just focusing in on the bona fide business purpose behind the exchange, it's not just for the exchange or property being making sense within the business. It's also that the debt that was incurred must have been for a business purpose. And so if you took out debt for personal reasons, it's going to kick the entire transaction out of 357A. And as a result, any of the funds received will be treated as boot. In fact, any of the liabilities assumed will be treated as boot. So if any portion of the debt was incurred for personal expenses, then the entire debt will be deemed to be boot under 357B. So even if there was a loan for the property and only a small portion of that loan related to personal expenses, the entire amount's out. So just something to keep an eye on. That ties into the bona fide business purpose behind the exchange and the liability.
Okay, so just a couple little housekeeping items that are important to keep in mind. You may have some questions in regards to Beth's transfer of stock. Again, not worrying now about liabilities, but the mere fact that Beth has transferred these assets into the corporation and received stock and received basis in exchange. Well, there are a couple of things going on with Beth's particular transaction. So she contributed equipment from a prior business that was originally purchased for $300,000 and was depreciated for tax purposes by $120,000. So again, basis 180, fair market value is 200. Well, what would be the nature of that gain if she were to sell it? Well, if she were to sell it, she would get depreciation recapture. And so what happens? Does she have depreciation recapture on her stock? Because she has a basis in the stock now of 180. It's a transferred basis, or it's a substitute basis. So does she have basis of 180 and any gains on that stock are going to be recaptured depreciation? And the answer is no. The depreciation recapture potential carries over to the corporation. And so she actually improved the nature of her asset by getting a capital asset, stock, in exchange for a severely depreciated asset. So that's one tax consideration that is not insignificant. That's important for Beth. So she just transferred the nature of her unrecaptured depreciation for stock with basis of the same level. The corporation, on the other hand, is going to have to recapture that depreciation when the asset is sold. So if it's sold at a gain, corporation is going to carry over that nature of the gain and have a tax as if the corporation itself had depreciated that property prior to it being transferred. So that's the way recapture considerations come into play. Next, I want to talk about holding periods. So for capital assets, this is particularly important for the shareholders, as you may have learned in your introductory tax course, or if not, you would have gone in great detail in your property tax course, that when you hold a capital asset for a year or more, for more than 1 year, you then get taxed differently on it if you're an individual. We talked about how corporations, that doesn't really make a difference for corporations, whether it's long-term, short-term. But for individuals, it does make a pretty big difference because a long-term capital gain is taxed at a lower rate. Again, if they're in the 39% tax bracket, it's going to be a 20% rate. If they're in the middle tax brackets, it's going to be 15. If they're in the 15 or 0% tax bracket, it's going to be 0. Most of your clients are not going to be in the 15% or 0% tax bracket unless they're retired and they already have all their assets purchased, so they don't really need income. But by and large, your clients are going to be in the other two. But they still will care about recognizing capital gains on items. And so the question of the holding period comes into play, because how long have you held this stock? Well, I just exchanged it for property that I've been holding for 3 or 4 years, but I've only had the stock for a short time. So what's going to be the nature of that gain when an individual sells the stock? Well, and additionally, you look at it from the side of the corporation. The corporation has now just received an asset. How long has it held that asset? Is it a long-term or short-term asset? So the corporation's holding period for the property acquired in a 351 exchange is the holding period of the transferor's shareholder, regardless of the character of the property in the transferor's hands. So again, capital assets, there's a somewhat limited definition of capital assets in the sense of income producing properties and properties to be used in a trade or business. That actually prevents them from being considered capital assets in some instances. So without getting into the definition of capital assets too extensively, just know that the holding period is going to carry over. So the corporation is going to be deemed to have held those assets for the period of time that the transfer held them. And the transfer is going to be deemed to have held the stock as a capital asset for the amount of time that it held the property that transferred for that stock. So you can see a pretty significant tax benefit in terms of the nature of the way these assets are held after the 351 transfer. So now let's take a look at, I want to think a little bit about the capital structure of a corporation, and more particularly, I want to consider debt in capitalizing a corporation. So if we think of a capital contribution corporate structure, the corporations recognize neither gain or loss on the receipt of capital contributions. So they get free money. Well, not really free. They're trading stock, exchanging stock for it. And the contributions from shareholders are given in exchange for stock. There's no gain or loss recognized by the corporation. That's Section 1032 provides for that. So when again, this isn't on property, but just any contributions made to the corporation isn't going to recognize gain or loss. The corporation generally has a basis in the property equal to the shareholder's basis, as we discussed under 351. And then pro rata contributions to corporate capital by the shareholders that are not in exchange for stock. There's no income recognized by the corporation, so it's not treated as income. The corporation generally has a basis in the property equal to the shareholder's basis again, and the shareholder recognizes no gain or loss on the transfer. So it's a pretty good deal for corporations. And it's so good, in fact, you might ask, well, why would they ever go into debt to capitalize their company? Well, in addition to recognizing no income, which is the same for debt, you don't get a deduction for dividends paid when you're a corporation. So, but on the other hand, if you take out debt, the interest is deductible by the corporation, which eliminates the burden of double taxation. Whereas a dividend, on the other hand, is not. A dividend is not going to be deductible to the corporation. So, from a capital structure perspective, there is a benefit to the corporation to utilizing debt. Now, there's another way of looking at this from the shareholder's point of view, and that's that the shareholder is going to decide whether he's going to put, let's just say, $100,000 of capital into a corporation, or alternatively, put a significantly lesser amount and borrow the money, have the corporation borrow the money. Well, if the corporation borrows the money, they're going to get a deduction for the interest that they pay. But granted, the interest has got to go out the door, so it's a deduction, but there's a cost associated with it. But from the shareholder's perspective, if he can beat the cost of capital, so if he can take that $100,000 and invest it elsewhere and get a return that's greater than the cost of capital, let's say it's 5%, so $5,000 a year. If he can take that $100,000 and spend it somewhere else and exceed the 5%, and the corporation can exceed the 5% as well, the shareholder comes out much further ahead. And so really the issue of contributions of capital as opposed to debt, you can see why there might be an incentive to go to debt. When you have the deduction to take into account, which avoids double taxation, that you don't avoid for dividends, and you take into account the fact that if the corporation is not capable of beating the cost of capital, then why the share, at least if the shareholder doesn't believe that to be the case, then the shareholder isn't going to invest in the corporation in the first place, because he would rather just invest elsewhere and get a normal return. And so the belief of a shareholder is that it's going to beat the normal return, at least typically, unless there's some sentimental reason that they're contributing cash to this corporation. And so you can see how there is a significant incentive. There's a significant incentive for corporations to incur debt and pay interest expense because of that.